Thank you everyone for joining the conference today. This is our monthly conference, and what a perfect time to discuss global macro. The last 1 week we have seen, or rather last 2 weeks, we have seen intense volatility, be it commodities, be it stocks. So I think we'll go through that, and hopefully that will generate a lot of questions, and we'll take all the questions from all of you towards the end of the session. If you have any questions, please feel free to type them in the Q&A part of this webinar. Our team, both Suman and as well as Aishwarya, are there on the call. They will read out the questions. And with that, I'll hand over the floor to Sunil. Go ahead, Sunil. Thank you.
Hi. Thanks, Ketul, and good morning to everybody. I'll just do the initial part of the presentation, and then Ketul will take over on more specific affairs. So first, of course, the biggest news was the Fed chair nomination, right? And what's caused a lot of concern in the markets, and we'll look at what happened to gold and silver, is because Kevin has a history. He's been a hawk in the past. In fact, in April 2009, the depths of the GFC, he expressed public concern about rising inflation, and unemployment was 9%, inflation only 0.8%. And he says that inflation is a choice, and obviously follows Milton Friedman, who says that inflation is a monetary phenomenon that the Fed chooses to allow. Right? So pretty dramatic view. And in fact, he resigned from the Fed in 2011 due to disagreement over QE2 with Ben Bernanke. Right? But there is a nuance to his approach, right? It looks like he's more anti-liquidity efforts than with the rate cuts, because in recent times he's argued for the rate cuts, citing that there is an AI-driven productivity boom in the economy, which is creating that capacity so that the economy can grow without necessarily causing inflation. And so he's willing to, in fact, fall in line with what Mr. Trump wants, lower short-term rates to help Main Street. But this whole liquidity infusion is actually subsidizing Wall Street, is his opinion, and not really doing anything to the economy. So probably we will see when he comes to think that he'd start a QT program maybe, but he will probably be more comfortable with allowing a interest rate cut, subject of course to inflation. But let's look first at what his just announcement of his nomination did to the market. The next slide. Right? So it's gold and silver obviously crashed, you're aware, and this has been labeled the wash shock, right? Because of what we just spoke about there was a major worry that markets, gold and silver have been rising for various reasons, right? One is, of course, safe haven against geopolitical risk. The second is the dollar debasement. That's interest rate cuts will lead to weakening dollar, and hence it doesn't make sense to put money in a currency that's earning you less versus a real asset which earns you. Though there are no earnings to real assets, it does. So this is a typical past behavior which has driven gold and silver up. Two of the major causes. There were other causes in silver, for example, its industrial use and the supply shortage. But on that day, what happened is this rapid run up had led to a lot of positions in the market, right? And when this news came in that the rate cuts are not going to be as simple and straightforward, and people didn't have the time to look at all this news, they just thought, oh, he's a hawk, and so he's going to raise interest rates. And what happened was, because normally such news is balanced approach and people take a look and wait for his public utterances. But what happened was the triggers in the market, because positions are built up, algorithmic triggers get triggered in, and then the downward loop started, right? So the major, even in India, the MCX, the COMEX in the US, they had to raise margin requirements to 20 to 25% to combat the volatility. And hence the new cash, those who couldn't do that had to sell their positions. And as gold fell below the $5,000 support, it triggered thousands of automated stop loss orders. And silver, which is far less traded and thinner, more speculative, so even more violent selling, it dropped over 40% in 3 days. So this was the major earthquake which just the announcement caused. And the second part of it, of course, is that President Trump, he also spoke to G, so some easing of tariff-related tensions there. Then, of course, the US-Iran conflict meeting in Oman, and the initial direction from that is that Okay, they are going to top. So an easing of geopoliticals is also negative for a real asset shift, right? So all of these have contributes to what is called a geopolitical risk premium, or more commonly referred to as a war premium, translating into a peace dividend, as they call it, right? So that was about what happened to the gold and silver because of the announcement. But let's look at the actual inflation, because that's what is going to actually drive Mr. Walsh's behavior. He's a balanced, reasonable individual. And there, when you look at it, what we have put on this chart is not just an inflation chart. It's the difference between a regular treasury and the inflation protected bonds, right, that are in the marketplace. Because the inflation protected bonds give you a sense of future expectations of inflation. And that you can see has spiked up. So if inflation is spiking up, then that makes the case that even Mr. Walsh is not immediately going to be able to just cut rates, right? Because that's a factor to be considered. So what's the reason for this? If you look at it, so many US companies had stockpiled goods to avoid the initial tariff. As you know, tariffs I think came in about August or something, and the Christmas orders needed to be filled in. So even countries like India saw a surge in exports just before that to beat the tariff deadline, and they stockpiled those assets. And now those inventories are running out, which means that the demand supply situation is getting fundamentally altered. And that's why everything has led to a fresh set of price hikes from machinery to electronics. So clearly, independent of Mr. Walsh's thing, the inflation data are not supportive of an immediate rate cut. It's the current state of affairs. Okay. And as we move now to the next slide, right? Right. So now when you look at the June meeting, which is the next probable meeting, right? So they are expecting February 11th, right? Just a couple of days from now, that there will be a BLS report, right? And this has been the weakest year for job growth. So no, that's again something that the Fed really takes into account in terms of the rates. So this anticipation of the weaker past data which already drove a 50 big cuts in June 2026. So we need to watch both the inflation expectations and the job situation to take a call. And the situation will undergo multiple changes between now and June. Take it from me. The data release will cause literally an ECG chart in terms of the expectation. So I think the trick is not to sit down and predict what comes. There will be probabilities going on in the marketplace, but as we get closer to it, right, is where we will now be able to get a closer call on whether a rate cut is going to come through, right? And I think there's one more slide here which I need to cover. No, I think I'll hand over the floor now to Ketul. So with that broad summary in terms of the landscape, so to speak, in the US, right, which is where a significant portion of Wayford's portfolio is concentrated, right? And I'll now ask Ketul to take you a bit deep dive into the actual AI and all those practical stuff which make a difference to the fund management process. Over to you, Ketul.
Thank you, Sunil, for the detailed explanation. Very useful. I think now we will do a little bit of a dive into the portfolio about what were the things that impacted our portfolios in the last, I would say, mostly the month, but the last 2 weeks were the most important ones, and especially the last week has been quite volatile. So one of the first things that we saw was a crisis in the software space. Why was this crisis triggered? Because typically the SaaS software industry model, which is where you use Microsoft email or you use Microsoft Windows, all the fees and licensing is on a per seat basis. That means it's on a per employee basis for enterprise companies. When you have licensing and revenues on a per employee basis, and then here comes AI, whose entire premise is that they will reduce the number of employees, which means they'll reduce the number of seats that are required. It kind of hurts the revenue model that these SaaS companies are working on. Now, this is not new information. This has been around for more than 2-3 years. And the market was grappling with that. We had actively evaluated that, got out of companies that were purely based on the seat-based model. But now what happened? Apart from this seat-based model, something interesting happened when Anthropic, which is offers one of the best LLM models, they introduced a plugin for one of their software, LLM software, where an agentic AI can directly do a lot of mission critical work, which a legal software, a vertical legal software in that industry could do, which means it could replace that software. So now you have another issue. It's not only your model is changing for the software industry from a per employee or a per seat model to a more of a usage-based model. Now you have softwares that are replacing the entire SaaS software. So the product is big. It had a moat. Now that moat is going away. So your revenue was threatened, and then your entire business model had major competition from LLM companies or AI tool companies. So this really hit the market hard at a very bad time when we had this volatility from the gold and silver crash. This hit at the exact same time. And so that led to something that we call it, shoot first and ask questions later. Now, this is what caused the software meltdown in the last 1 week. Now, many companies have shifted away from this per seat model, but they are still, they still could have this issue where their entire software could be replaced by AI. And so the first reaction is sell everything. We don't know what is going to be impacted. The market sold off everything. Now, in the last 1 or 2 days, we are seeing some differentiation happening between the software companies, where now people are thinking which companies have a higher moat, which companies have a lower moat. And the companies which have a higher moat are now recovering. And we do see that happening in the market. Yesterday also was that day where a lot of recovery we saw in some of these names. But that is what caused the problem. It was caused at the exact same time when this gold and silver crash happened. So the impact of it was just exacerbated, right? Normally, something like this, you would see a 1 or 2% move in the software companies. Because of this, the moves were in the 8 to 10% in every software company in the world, right? Almost 99% of them. So that's what was the big thing that shook the software market. If that was not enough, typically healthcare is the one which is totally not correlated to software. So the idea in a typical portfolio is that when you have issues on the software side or the tech side, healthcare will help your portfolio. Now, why that also did not work very well? Because all of this happened at the exact same time in the same week. That is more important. If they happened in separate weeks, it would not impact the markets so much. But all of this happened in the same 2-3 days. So what happened on the pharma side was that Hims and Hers, which is like the Amazon of pharmacy, they provide online pharmacy in the US, online pharmacy delivery in the US. They offered a compounded semaglutide for $49 per month, which is way less than similar patented products from Novo Nordisk. Now, Novo Nordisk and Eli Lilly offer patented weight loss drugs. And there are many other companies that are working on this patented weight loss drugs. But Hims and Her found a regulatory loophole whereby they could personalize it with some small ingredient change and could offer the same pill for $49, which shook the markets, which shook the big pharma company. Because if this was allowed, then a lot of other therapies, not only weight loss drugs, other therapies also, people could use that same loophole and provide cheaper drugs, generic drugs, at a much lower price compared to the patented drugs. Now, so that was the first few days. Immediately, there was a response from FDA. This is the fastest I have seen FDA move. FDA never moves so fast. Within 2 days, FDA got into action. The first thing was FDA Commissioner Marty McCurry. He issued a statement that there will be swift action against these companies who are using this loophole to make copycat drugs and selling it at a much cheaper price in the US. That was the immediate response. And if that was not enough, the very next day, the Department of Health and Human Services, which is obviously in the control of President Trump, he appoints the head of Department of Health and Human Services, right? So that department confirmed that they are starting or referring Hims and Health to the Department of Justice for potential violations of the Food and Drug Cosmetic Act. So this provided some comfort to the market. The market recovered to quite an extent, but obviously in the first 2 days, a lot of damage was already done. And again, I cannot stress enough the point that this happened at the exact same time when there was an issue in the software stocks, when there was an issue on the commodity market with gold and silver. So it seemed like a perfect storm where you had issues in the equity market, issues in the commodities market, and all of them hitting at the same time. And so it got a lot of investors really worried and nervous. We stick to our portfolio. We did a few changes because whenever such things happen, remember, a lot of stocks which are also not supposed to be beaten down are beaten down. That gives us an opportunity. We were looking at a few stocks from the last 2 years. We could never buy them. This gave us an opportunity to buy them. So we did make those changes to the portfolio where we entered a few stocks which we could have never done in the last 2 years because of the valuation. This gave us an opportunity. So while these are issues, and yeah, there was one more issue that happened at the exact same time. Remember, this is the earnings season. All the four large names in our universe and in the AI universe, Amazon, Google, Meta, and Microsoft, they came up with earnings. Now, the problem that the market saw with these earnings is on your slide. Each one of them, starting with Microsoft at the lowest number, $120 billion, to Amazon, who said that they will spend more than $200 billion in 226 alone, not for 5 years, not for 10 years. This was their Capex estimate for the calendar year 2026. And this kind of overwhelmed the market. The total between the four, and these are just the large four, the overall Capex is expected to be $1 trillion. Just between these four companies, they estimated that they will spend $650 billion. And this is roughly, for Google and Amazon, it was 40% above what the street was estimating, 30-40% above. Now, that really scared the market because when companies spend these type of amounts on Capex, the street gets worried whether the returns will follow or not, because the Capex happens in this year, the returns will come over the next 3 to 4 years. And if those returns don't come, it's a problem. And that's what got the street really worried. And just to give you a reference point about how big this Capex is, 200 billion Capex by Amazon in calendar year 2026 on AI is roughly equal to the entire market cap of Reliance Industries. So they are spending one Reliance Industries value in just calendar year 2026. So that is what the magnitude of the spend is, what is really caught the street unaware, and people started getting worried about the returns on that. Again, I cannot stress enough, this happened in the same week where we saw the healthcare regulatory issues, the software issues, and the flash crash in gold and silver. So you put all of that together and you can see how a concern like this, which would have caused a 2-3% drop in these companies which announced this Capex, it led to a 10 to 15% drop in each one of these companies. Some of the companies like Google were spared because of the market's confidence on Google, but the other companies were not spared. And of course, Meta was also spared, but Microsoft and Amazon were not spared. Both of them saw drops of 10 to 15% in that week. Now, why we feel that this is not a concern? First of all, the whole reason that they are spending is because that part of their business is growing at the rate of 40 to 50%. Now, this is not a small startup company where your revenues can grow at 40 to 50%. Google's estimated, and this is before their earnings results, their estimated CY26 revenues for their AI business, just the AI business, not the entire search and the advertising business, which is the largest part of their business. Just the AI infrastructure business, the estimated revenues were $80 billion. So you can imagine this $80 billion is growing at the rate of 40 to 50%. This is just crazy growth. I have never seen in my entire stock market life in 20 to 25 years. I have never seen a $80 billion business grow at 40 to 50%. That is just unheard of. So that is these numbers are just so difficult to digest for people. And it happened in the same week that there were all these concerns and the market sell off. Now we are not worried because the whole reason that they are spending is because they're growing. And then you have to worry that, okay, they're spending, they're growing revenues. Is it profitable growth? Are they making money over there? And so that proof is always in the numbers. And we can validate it with numbers. For example, Microsoft, their EBIT margins in the Azure business, which is the AI software, AI infrastructure business, not entire Microsoft, not the software business, just the AI infrastructure business where they are spending $120 billion. Just that segment, their EBIT margins are 43%. If you have a business that and growing, if you have a business that can give you 43% EBIT margins, why would you not spend on it if there was customer demand? It makes sense that Microsoft is spending on that. We totally agree with it. Unfortunately, the street is worried. And so we are not too worried about that. And another company, so you compare competitors, right? Google. And this is not Google's advertising business, which is a pure cash flow. It's a cash machine. We are not talking about that business. We are talking about the cloud AI infrastructure business, which is where they are spending about $180 billion. Okay. That segment EBIT margins, if you see in the first quarter of 23, when the whole AI revolution started with ChatGPT, it was at 2.6%. In the last quarter, in September quarter of 25, they reported that as 23.7%. And in the December quarter, that went about 24%. So when you have such growth in margins in a business where you are growing an 80 billion top line business at 40, 50% per year over year growth, it's just mind blowing. And we don't see any issue over there. The street definitely got worried, but we are very confident that this is a very strong business. And their RPO, which is a measure that these companies use. RPO is the forward booking or the revenue that has not been booked, but they have the orders. That is also growing at 60, 70% year over year, right? So their orders for the next 2 years are booked. It's not like you have to worry about whether they'll grow. Okay, this year they are growing 60%. What happened next year? Next year, they are growing at an equally fast pace because you have the orders. You have the revenue in the RPO order book, which is pending. And so, and the valuations are not high. You are not talking about 100 PE company. Google, Microsoft, they all trade in the 20 PE ratio range, right? 20 to 25 range. So you are not paying for that 60, 70% growth in these businesses. And so that kept us pretty level-headed. We did not get into any concerns about these companies. We did not do any panic selling. And so this is the time when actually we were telling our investors that if you have the conviction, if you have the cash flow, you should invest. This is a good time to invest. And we continue to say that these issues, they happened at the same time. Some of them are real issues, some of them are not. We obviously differentiate between the two and move our portfolio in the direction where we don't see issues. But when the market sells, they sell everything. So this is the time we actually churn our portfolio a little bit and get into stocks which we feel we could not buy in the last 2-3 years. And so absolutely a good time to invest. I know this will be a common question that we get on the webinar as well as in our interactions with all our channel partners and clients. This is a very common question. In spite of all this madness that you see in the market, we do see calmness, in the days ahead in the market. And these are the times where if you were complaining about valuation in the last 1 to 6 months, that complaint is not valid anymore. But now if you get worried because the markets have crashed, you are getting mouth-watering valuations. And now if you don't pull the trigger, then you cannot have it both ways. You cannot have low valuation and a bull market, right? They don't go well together. So either you will have a bull market and valuations will be high, or you will have a market like in the last 2 weeks where stocks have crashed and the valuations are mouth-watering, but you will be scared. And we understand that it is quite normal to be scared, but this is the time where you have to show that you are open to good deals, good value in the market, and you are ready to invest. And we do feel this is one of those times where we feel over the next 2 3 months the markets will calm down a lot, and these valuations you may not get them again. So we have discussed this many times in the past about the US bull and bear. All the same arguments remain, with some of the arguments that Kevin Walsh, as Sunil rightly said earlier in his presentation, that Kevin Walsh is more of a hawk. So people got worried whether there will be rate cuts or not. But we are not worried on the rate cuts part. I think President Trump has nominated him, and President Trump is not shy about asking direct questions. You can be very sure there was a direct question that was asked to him before his nomination. Will you cut rates after May? If the answer is yes, he was nominated. If the answer was no, he would not have been nominated. So we are not too worried about that. He is, in spite of his hawkish credentials in the past, we do feel that he will cut interest rates. And the first time we will hear from him will be during the Senate confirmation hearings that will happen after 2 weeks. So unfortunately, he's not going to speak in public before that. So there is a 2 week time window wherein there could be speculation about in the markets. But in the Senate hearings, there will be direct questions that will be asked to him by the senators. Will you cut rates? Because this is one of the most important topics, and not one, there'll be an hour or more that will be spent on this discussion. It is a public hearing, which means it will be televised live on all the major networks around the world. Everybody will be able to see his response and come up with a conclusion of their own. And we do feel that during these Senate hearings, he will establish his credentials as somebody who is going to cut interest rates, and that will definitely cool down the market. Even before that, the jobs report that are going to come on February 11, which a lot of firms like Goldman Sachs, they are expecting that there will be a revision of the 2025 new jobs added, and the revisions will be a negative for the number of jobs that were added, which will further help boost the case that the job market is not doing well, which means the Fed should cut interest rates. As soon as you start getting, we got some of that hint on Friday. That's why a big reason why the markets recovered on Friday was some of that was just the pressure of selling going away from 1 full week of selling. But one of the big reasons of the Friday recovery was because markets are expecting that the job growth will be revised next week, and that revision downward will make the case or will help the Fed make a case for further rate cuts, and it will help. And that's why the probability of the 50 basis points rate cut in the first meeting after Kevin Walsh becomes the Fed chair, that increased drastically. It went from 16% to almost 35% just on Friday. In one day, the chances of a 50 basis points rate cut increased from 16% to 35% in his first meeting that he will be the Fed chair in June of 2026. So because of that, the market got some more confidence and recovered to quite an extent, actually 2% roughly on Friday. So given all of this, we are definitely not worried. The fundamentals are strong. The valuations are also very good right now. The businesses are growing. There is no concern on the growth of the business. EPS is strong. We have a Fed chair coming in who is expected to cut rates. The fiscal stimulus, which is the one big beautiful act, will come into play this year because the tax cuts that were announced in the One Big Beautiful Tax Act bill in 2025, now the cash flow actually hits the US economy, corporates, as well as individuals. So you put all of this together, and 2026 is a perfect time for very good stock market returns. We have no doubt in our mind. There will be bumps along the road. It's not going to be a straight line up, but whenever there is a bump along the road, we strongly believe that is a time to add more money or initiate positions if you have not already initiated a position. So I will pause over here and we will take questions. Sunil is also over here. If you have any questions on the US macro, I'm sure Sunil will be more than happy to answer over there. And Aishwarya and Suman, please go ahead with the questions.
I think there's somebody puts question on the chat.
Okay. Is Aishwarya and Suman not able to speak up, or their audio is not enabled? Let's see.
Hello, sir. Am I audible?
Yes, you are audible, Suman. Go ahead.
Yes, sir. So the question is, what could be the effect of Indo-American deal on our investments in US market?
I will start, and Sunil is probably more of an expert on that, but I will give a two-line overview of that. On the US markets, it doesn't matter much because the India-US trade is so small for the US markets. As I said, Amazon is spending the entire value of Reliance Industries in 1 year as Capex, right? So the India-US deal in terms of magnitude for the US stock markets is very small. It doesn't impact the US markets, not at all. The impact on the Indian markets, Sunil, please go ahead.
Yeah, I'll do that. And even from the US market, look at the US economy. The US economy had a deficit of $1.2 trillion. Okay. And India's trade surplus with the US is $48 billion. So we are hardly 3% or 4% of their deficit. So it's a drop in the ocean for America. Though the trade deal itself, the interim thing which came out yesterday from the press release, it does appear that America has actually gained significantly because they are reducing their tariffs to 18, whereas India is likely to go to 0 on a lot. There's also the clause around the Russian oil, which is a $1 trillion question because I think we haven't told Russia yet that we're not going to buy it from them. Yes, both the US and Venezuela, and if the Iran issue gets sorted, Iran will be a key source of supply to India. Iran and India have been good friends. It's because of the sanction that we stopped. But now if the talks go well and Iranian oil is allowed to come into the market, it's definitely something that India will latch on to. How we handle Russia diplomatically is I leave it to Mr. Jaishankar. He's done a fabulous job of diplomacy, and I think we will probably agree to buy more Russian arms or something of the sort, right? So I think that's a very touchy subject, so to speak, because India officially cannot also admit to this factor. So I wonder how it's going to play out. But net as a result of this, I would say is that for the Indian economy, right, the opening up of certain segments of agri, like the soya and the corn market, is probably going to be a little bit of a challenge for some of the companies here. But the overall positives to the MSME business, because 40% of India's GDP is in MSME. So again, it's not in the stock market, bear in mind. So the reason I'm saying that is directly on stock market companies, you've already seen textiles, leather, gems and jewelry, those companies already run up, right? Because they've anticipated this moment Mr. Trump sent out the tweet, right? But I think that the benefit of this deal is going to be far wider and far longer, because when the MSME export business gets a thrust, right, it's going to create jobs and it's going to ultimately lead to more consumption. And that's the real driver and the private capex. So I believe this deal is hugely positive for India from an economy perspective. And so from a market perspective, yes, there are people who want to bet on the tariff impacted sectors, but I think they've already run up significantly. There's no harm in continuing to take exposure on them because they are definitely going to benefit because it's not just the US, because the Indo-European deal also got signed. So definitely exports are going to be a big sector, and maybe you can look at exports as a portfolio allocation, right? Whether it is, I know IT and pharma are not a part of the tariff piece, but and IT, as we just spoke today, has these challenges on the anthropic matter. But definitely overall exports of India, goods exports is going to benefit. And second is, as I said, the longer term benefits are more to the economy. And so keeping a broad-based exposure to the Indian economy, I think, is something that you would be advised to do as a stock market, because those are the real benefits going to flow through. So effectively, so investment in the US market, I don't think it's going to make any difference, like Ketul said, to any US stock or anything because of this deal getting signed. See, India might agree to buy certain defense equipment from some of the bigger US companies, but I don't think we are going to do any defense related specific stocks or anything like that. So that business could accrue. And if you buy oil from the US, buying US oil majors is again a big commodity play. So I don't think Bayford's portfolio at all looks at it from that angle. So I'm not sure that this deal at all makes a difference to the US prospects, but to Indian prospects, I think it makes a significant difference.
Thank you, sir. Another question from the attendees is, with the US sector, do we see a strong uptrend now in 2026?
Yeah, so I think one is obviously if somebody is spending $650 billion, somebody is receiving that, right? So the companies that are receiving it primarily are the beneficiaries of AI Capex. They are semiconductor companies, they are power companies, they are power equipment companies, they are data center companies. All these companies are the receiver of that $650 billion in Capex. Now, obviously, one thing that we have to be careful is that this is not new Capex. Last year, it was, say, $400 billion. So these companies have already run up in anticipation of this. So that is something we have to be careful. But yeah, anybody who is on the receiving end of this $650 billion worth of Capex is benefiting. And then there is the entire ecosystem for software infrastructure to run this. You have security companies, you have database companies, you have companies who will do this integration, because while AI is going to help you, somebody needs to code this AI also. Somebody needs to integrate this AI in your enterprise systems. If you are an easy example, say a telephone company, Bharti, right? You have a few crores of customers. Somebody needs to collect all of that data together in a single database, process it, analyze it, understand it. And for that, you need people as well as software, right? It's not going to be done automatically. It will be AI software, but you will need some software. So companies that are in that space are a part of the receiving part of that 650 billion. And on the positive side of that trend. So I think those are all the companies that will benefit. Power companies are the ones that are expected to benefit a lot. So that is something that we have looked at in the past. Renewable companies, nuclear power companies, all of these companies are expected to benefit. So yeah, that's pretty much it.
Thank you so much, sir.
Sunil, you want to add something?
No, I think that, and that's this. I just want to use this answer to answer another question which I see on the chat saying, why do you think that if you compare with the Indian market, why do you feel US market will provide better return? Is a question they're asking you. So I'd like to address it in the context of this. Is that, see, one of the reasons, right? I mean, the Indian market has suffered from an FII flow perspective over the last year and a half, is because we are being perceived as anti-AI. Okay, and so many people who little bought India also bought us as an AI hedge. Okay, but what you're seeing from the slide here is that AI is not going anywhere. In fact, it's picking up speed and strength. And so from an India perspective, I know the budget announced something for data centers and for AI, but it's a very long, hard journey. So to the extent of foreign capital coming back, remember that it's going to take a lot of effort for FI money to come back in a big way, because leave the valuation story aside. You've seen so much good news around India, the GST cuts last year, the income tax cuts last year, the budget giving a pro-economy situation. RBI is supporting to 125 bits rate cut. In fact, the RBI governor referred to this as what do you call that word, Goldilocks scenario for India. But that Goldilocks scenario for India as an economy is not a Goldilocks scenario for the Indian market, right? You can clearly see that. So the point is, nobody is denying that India is going to continue to be the fastest growing country in the world. Nobody is denying that we are fiscally very prudent. We are an excellent investment option. But are we going to show the kind of growth in the stock market over the next year, 2 years, that an AI-driven country is going to show? And this is not just about the US. It's about Korea. It's about Taiwan, which are all feeding off the AI boom. In fact, China saw a massive sell-off in the last week of January because of certain issues on the day started curtailing. So the point is that we've talked about AI here. India is actually a little on the back foot today because we have missed the first step in the AI. We will catch up. The government is aware. We have a very proactive telecom minister out there who made a very good presentation even at Davos about India's capabilities and what we're doing. But it's going to take a long time, A, to catch up, B, to convince FIIs that, and mind you, these companies have to come to the Indian stock market. Now, who's doing the semiconductor? Tata's, is that company yet listed? It's going to come in. So I think that India will chug along at a very good GDP growth rate, nominal GDP growth rate, and domestic flows will ensure that there's no significant correction. And we will give decent returns, decent double-digit returns on the Indian stock market. But the potential to catch on to the new wave, right, of AI arises out of India. I'm not making a case only for the US, but out of India. I think the AI boom, people said it'll bust. Is it like the .com boom? You can now clearly see that it's not. It's a new industrial revolution taking place. So I think that a critical part of an international portfolio's role is to precisely hedge yourself against India from this AI-related story that's going on in the world. So to that extent, it's not to say that there won't be quarters where India's stock market growth will beat the US stock market growth. There will be. But just that, most importantly, this international diversification is a diversification. Nobody is saying go and invest in the US or outside because India is not going to do, so put all your money. No, it's just that as a part of a diversified portfolio, you should have an exposure in things which are contra to what you already hold. And an AI play is clearly contra to India even today. So among various other reasons like currency depreciation and other aspects, AI is a significant reason for Indian investors to have an allocation out of India, especially from an AI, just from an AI filter. There will be multiple other reasons. I'm not talking about the commodity super cycle. I'm not talking about any of the other aspects, right? But just makes sense from diversification. And I think if you look at Bayford's portfolio, right, the way it is structured, you can clearly see that it offers that diversification benefit to a pure India portfolio. So I think, Ketul, you want to add something to that?
No, I think you covered all the points. I couldn't have done it, said it better way myself. Thank you very much for that explanation. Suman, go ahead with the next question.
Yes, sir. So there's another question we have is, are we taking exposure in European defense and allied business going ahead?
So we have taken not particularly European defense, but in US defense companies, we recently got a chance to add exposure. So we have added exposure to US defense companies. European defense, we still are not seeing that type of growth that we want. Remember, we are a high growth portfolio. We need 20% plus type of growth companies. And grow and with decent valuation, right? So unfortunately, we haven't found anything. But yes, US defense companies, and they definitely operate in Europe also. The companies that we are invested in, they benefit from the European defense expenditure. We have taken exposure, and yeah, we do feel there are opportunities in the defense space, especially drones. Drones is a space which is, I think, you must have seen in the recent conflicts around the world that drones is the future. Now, not only in wars. Now, wars is a one-off, application of that. That doesn't happen too often. We hope wars don't happen too often. But drones are gaining major usage in security. You see, if you have a concert in Wankhede Stadium, right? What is the you need hundreds of drones to protect Wankhede from the air as well, because, and that we are not seeing it in India, we will see it soon. But the US, it's a reality that an attack on a public venue like a stadium, a football stadium, or a cricket stadium could come from the air also. A person doesn't need to be inside the stadium. A small drone can actually throw a grenade onto a venue like that. So you have hundreds of drones protecting that venue or any public venue. So from a safety perspective also, there are hundreds of usage of drones. You have first responder drones where a police van or a police officer may take 15 minutes to reach. A drone can get there in 5 minutes. And before the police arrives, it can give an overview of the situation to the police that is on its way, right? So even before the police gets there, the police is having a video view of the situation so that they are appropriately prepared and they are not shocked or they don't get a surprise when they reach the location, and they have a bird's eye view as well as any view that they want, because the drones are already there 10-15 minutes ahead, and those 10-15 minutes are very crucial in a first responder situation, right? So there are so many such applications of drones that are coming up that I think we are focusing more on those civilian usage rather than the war usage of defense. And the defense spending, I think we will see in both those areas. Hey, Sumant, go ahead with the next question, please.
So, sir. So, speaking of European companies, so actually there's a question regarding China as well. So, if currently the valuation is cheaper, so why are we not looking at Chinese company now?
So Chinese companies historically have been a trader's market, because if you see the long-term returns for China, 25-30 years, it's 1 to 2% per year. Yeah. So if your historical 25-year average is 1 to 2%, and all of a sudden in a particular year you make 25%, the math and history is against you. Let's put it that way. The companies may be good, the prospects may be good, but the numbers and the probability is against you. So that is one thing that concerns us. We did invest in the Chinese markets in 2024. We made some 20-25% in a short period of time over 3 months. And as the math is against us, long-term average 1 to 2%, you make 25% in 3 months. Mathematically, you are fighting the market at that point. So we sold out of it. And that's another concern. But recently, there have been some concerns on the regulatory side. The Chinese regulator is the monopoly. They are worried about the monopoly of these companies, and they are cracking on some of these companies on the monopoly and restrictive trade practices. That's one concern. And remember, in China, there is no court. The executive branch and the judicial branch is the same, which means if the government decides that you are doing something wrong, you cannot go to the courts, period, right? Because the government is the court. And in the US or in India, that's one important difference to realize. If the government says something, if President Trump says something, one can go to the courts. In fact, there is a high probability that a lot of these tariffs that were imposed by President Trump will be disapproved by the courts. And at that point, President Trump also cannot do anything. So there is a rule of law. There is the judiciary and the executive are separate. In China, what most people don't realize is that the judiciary and the executive are one and the same. There is no separation, which means if the government says that you are under monopolistic behavior, you cannot go to the courts. In US, the government said that Google, Amazon, Meta were falling under that monopolistic behavior. Google went to the court and actually won the case. One case they lost, one case they won, but the effective impact was nothing on Google. Google was, when those court cases were going on, Google was at $1.5 trillion. Today it's at $3 trillion plus in valuation, right? So you could actually fight in the courts. Unfortunately, in China, you cannot fight in the courts. So That's another thing that scares us whenever the government is taking action against these companies. And off lately, there have been a lot of regulatory actions against these Chinese companies. That is another thing. Historical returns in the last 1 year plus government action that kind of concerns us. Now, having said that, we definitely look at Chinese companies, and if we do find opportunity, we will invest. But it will never be 15% of the portfolio. It's a well-diversified portfolio, so China, even in the best case scenario, will be, say, 5% of our portfolio. And so, yeah, I'll pause over there. But, Sunil, do you want to add anything on the Chinese companies from an emerging market perspective? No, I think, Suman, you can go ahead. I'm not able to hear Sunil.
Okay, sir. So another question is, how do you see USD INR to move further? So especially when the USD, weakens, and currently major currencies, if you compare, so currently, like what insights you can put, and currently, like moving further, how do you see that USD and INR will perform further?
Yes, so see, I think currency is not our specialty. We don't deal in currencies. But the historical averages are 3 to 4% per year is what the Indian currency depreciates. The only reason in the past Indian currency has either stabilized, which means it has not done that 3 to 4% depreciation per year, or reversed. And that has happened twice in the last 20 years. So you see the probabilities that you are playing with. In any calendar year, only twice in the last 20 years, if my memory serves me right, is the time when Indian currency has gained over the US currency. So you are fighting the odds if you say or believe that the Indian currency appreciates. History doesn't suggest that. Now, could it happen? Absolutely. In a few years, that has happened. It could happen again. Overall, India always has a current account deficit, which means we import more than what we export. Now, India as a country is definitely trying very hard to increase exports through these free trade deals, through these special zones, giving incentives to exporters. But I consider all of that as, for example, building a road in Mumbai. You're trying good. You're trying to build so many roads. But by the time that road is built, there are 50 other buildings and the population has increased so much that that road is pretty much becomes useless by the time it is built. The same is the story with Indian exports. We are trying very hard. We want to increase our exports, but that takes time. You have to build a lot of manufacturing facilities, and by the time those facilities are built, our imports in terms of crude oil, gold, silver, electronics, it increases manifold. So that exports that you increased doesn't matter much. And that keeps our current account deficit good and alive. And as long as you have a current account deficit, it is very difficult for a currency to appreciate. So consequently, we feel that the chances of Indian currency appreciating are low. Could it happen for 1 or 2 months? Sure. But over a long period of time, I would say the chances of that happening are very low.
Shall we go ahead with the next question?
Yes, please go ahead.
Yes. So there are many questions regarding impacts of current scenario in US, how it will going to impact the Indian technology sector. So we will combine all this question, and you can put some lights on this.
Sure. I think Sunil is back. We lost him for a brief moment. Sunil, you probably are on a mute. We are not able to hear you.
Oh, can you hear me?
Yes. I think, and this is the perfect time you joined back. The question was about the Indian IT sector and how it is being impacted. You are probably the best person to answer this.
So, okay. So, can you just repeat the question for me? Because I had my battery problem, so I switched to the phone. Sorry about that. The question about Indian IT?
So current US scenario, how it will going to impact the Indian IT sector?
So I think that if you look at the slide that Ketul had, we had presented on the thing, this thing right now, see, as far as Indian IT is concerned, they have been under pressure for quite a long time. If you take the last year, it's probably been the most underperforming sector in India. It had shown a bout of resurgence over the last 3 to 6 months because a lot of the companies, TCS, had announced some AI-related initiatives. They made investment in database. I think another company, I think also Coforge bought an AI company. So it was the anti-AI status of India perceived, so to speak, which hurt the IT sector naturally at the beginning, and that's what it was. Now the latest anthropic thing that's happened. Now there's been a worldwide IT sell-off, and so Indian IT has been further hit by that perception. And there, if you look at it right from a key perspective, is it's a SaaS-based thing that Anthropic has introduced. And so those who are servicing legal servicing in that, and those who are billing per head. Now, companies which are moved from billing per head into billing per call or billing per thing will be less affected. Second is all Indian IT companies are cash rich. So they have the ability to make those investments and change. Just like you saw the data on how much Google, Microsoft are investing. Indian companies also proportionately to that, of course, have got to be investing. So at this point in time, I would say that from an IT perspective, it's probably not the right time to buy the IT index because every company is not going to get equally affected. Every company is not going to react equally fast. Second is, it's probably better to wait out a bit before entering IT. If you're holding it, you can continue to hold the IT sector stocks that you hold. But I'm saying to take a fresh exposure, all these companies will need to come out with their disclosures on AI in the next quarterly earnings, definitely, because that's going to be a killing question because of this anthropic thing. So I think that they will all now be working overtime to get their act in order. But once they do that, they have the skills and the capability and to catch up. So I would say just wait out a bit because the heat on IT will continue for some time, especially overseas. When overseas starts recovering, not every Indian IT company will recover. It is those which are perceived then to be able to counter this because even overseas, it's not every IT company is going to get affected. It depends on company to specific company current model as well as how they are developing the future model. So it's a time for a pause and a wait on the IT situation. I'm confident, and none of this. Okay, that's another point I wanted to make. Whether it's international, also the Ketul may agree, or domestic, for the next year's earnings, these are not going to make a big impact. It's about the future. It's about the reading the tea leaves on the way the situation is changing. So we are talking about 2027 and beyond. So the IT companies' earnings in India now are going to continue along the way that they are given the guidance for. And relative to those, this correction has made their valuation more reasonable. But still, I hesitate to say that go and buy them now because of the correction, because I would say you wait for the heat to go away, because right now you might be catching a falling knife, right? Which is going to hurt you in both sides and your fingers will bleed. So just be patient. This is an evolving situation, but AI readiness is going to be the filter on which new IT companies will be favorites in the stock market. Okay, have no doubt about it because India as a country itself has got punished because of our non-AI readiness. Indian IT is at the forefront of that whole situation. So I would say if you're going to take company-specific views, you need to study them a lot to see who are heavily dependent on these kind of services, like whatever legal comes to mind, heavy documentation, heavy involvement of that where an agentic AI can come and replace, right? That's the risk. And one final point on this Anthropic, right? See what changed. Actually, OpenAI and others have been offering similar solutions for quite some time. What changed is that Anthropic has now put that on the desktop. So that's the difference between, depending on a cloud-based servicing coming there, they have parked this in the desktop, right? And that's what has created a scare, because then the user company can easily just take it and put it on its server, and then the need for going outside comes down dramatically, right? And that's where I'm saying to wait and watch, because the key part is they have now enabled that only for Mac computers. They have not yet enabled it for your Windows computers. So when that happens, there will be another major reaction to that, because clearly Mac's market share versus Windows market share in terms of installations is far, far less, right? So I would say there will be challenges. The roadblocks from AI will keep coming up to the IT sector over a period of time. So I would say just wait a bit, let the situation develop it. But like I said, valuation wise, they are increasingly becoming more reasonable now. And there would be spillover benefits from the India-US deal, because on the H1B visa front, everything you could see, because our terms are now better, there could be some relaxations from that. So keep a watch, wait and watch, I would say, at this point in time, but no need to go and panic and sell off your existing IT portfolio.
Perfect. Thank you, Sunil. Sumant, go ahead with the next question.
Yes, sir. So the same question is currently the impact of AI Capex with the new Fed chairman and US discretionary spending, etc. And that may affect on any companies here in India.
So, yeah, AI Capex is not only just in hardware, it is also developing massive amounts of software like Anthropic, Claude. And what AI Capex does is it makes all these things cheaper. So in 2023, a compute or a query used to cost, say, 100 rupees. Today it costs 10 rupees, which means the people who are working on these tools, they gain massive amounts of compute power and massive amounts of intelligence from this. So instead of now sending one query, you can send 5 queries for the same amount, for the same amount that you spend on it, right? So it becomes very lucrative to do all of this. And this is going to be a self-fulfilling prophecy, which means as AI gets cheaper and cheaper, the number of issues or problems or additional software that you can develop with AI is going to become cheaper and cheaper, which means it's a never-ending thing. So for our generation, for the next 20 years, we are going to keep seeing better and better AI tools because the cost of compute keeps on decreasing, and the number of the amount of research that is going on in that space is just phenomenal. And so you can expect that one after the other problem will be tackled by AI. And if you feel that a particular problem is not ever going to be tackled by AI, wait for a few years. Wait for 2 years. You will see an AI application that will tackle that problem, because the amount of research that is going on is just phenomenal. Now, some of them may take 5 years, some of them may take 2 years, some of them they are already solving today. So the question is not if, the question is when is AI going to solve that problem through an innovative approach. And when that happens, all the existing companies in that industry will be impacted. Today it is Infosys or Wipro. Tomorrow it could be some other company. At some point in time, if the companies don't adapt themselves and change themselves, AI is going to change them or going to force them to change. So for companies like Infosys and Wipro, AI is forcing them to change their business models. Hopefully, there are a lot of other companies who see this coming and they themselves change before AI forces them to change. So I think that's the differentiation you want to look at in any sector. Are the companies changing by themselves and adopting AI such that when AI actually comes to them, are they ready? Or are they waiting for AI to force them to change? If you are in the latter camp, waiting for AI to force them to change, then it's going to be painful. If you are in the previous camp where you are ready for AI changes and proactive and using AI to your benefit, then you are going to be a winner. That's how we try to separate between AI winners and losers. And that's one good way to separate for any industry, any company, because it's very difficult to make a generic statement that this industry is going to win or this industry is going to lose. But if you think from these lenses, then it will make a lot more sense and a lot more easier to evaluate every particular company on a situation by situation basis.
Ketu, I need to drop off. I have another interview to take on. Okay.
Perfect. No worries at all. Thank you, Sunil. Thanks for the time.
Thank you.
I think we'll take last one or two questions. If there are any in the queue, we are above the 1 hour mark. So last couple of questions here.
So far we have received all these questions and we have, I guess, almost covered everything. So while closing, in case if you would like to add some comments.
Wonderful. So I think I see on the chat some questions which are company specific. So we try to avoid company specific questions, but companies like Micron, Nvidia, we are looking at each and every one of them on a daily basis. That's always on the top of our mind. These are beneficiaries from the Capex that is being done, because that $650 billion Capex is coming to companies like Nvidia, Micron, because that is what people are buying with about 70 to 80% of the Capex that goes into AI infrastructure goes to either chips or memory or servers or racks. It basically goes into buying hardware for the AI infrastructure, 70 to 80% of that Capex. So we are looking at all of these companies in excruciating detail on a day-to-day basis, because the winners and losers in this space are also changing, not on a day-to-day basis, but say every 2-3 months, the winners and losers in this space also changes. So rest assured, we are looking at that, all of them in excruciating detail, and obviously changing our positions in response to our view for these companies as and when they change. Thank you very much, everyone, for attending. We definitely look forward to you all joining again on the first Saturday of next month. We have this webinar for everyone to attend on the first Saturday of every month at 11 a.m. Thank you very much. Till then, have a nice month. Bye-bye.